March 2026, credit markets freeze in the United States. Within days, the contagion spreads globally. By the end of the month, every major financial center is in crisis mode. What follows is not a quick correction or a temporary recession. What follows is 5 years of systematic collapse, failed recoveries, cascading failures, and the slow disintegration of the post-war economic order. This is the timeline of those 5 years. Month by month, quarter by quarter, the mechanisms of collapse, the policy failures, the false dawns and crushing disappointments, the transformation from financial crisis to economic depression to social and political upheaval. Let me show you exactly how the first 5 years after the 2026 crash unfolded. Not speculation, not theory. The documented progression from bad to catastrophic to structural transformation. Year 1, March 2026, February 2027, the crash and initial panic. March 2026, the breaking point. The crisis begins on March 2nd, 2026. A mid-tier corporate borrower, a retail chain with $8 billion in debt, announces it cannot refinance bonds maturing that month. Markets have expected stress, but not default. The company has been operating for 40 years. Investment grade rated until 6 months ago. The announcement triggers immediate reassessment. If this company can't refinance, who else can't? Credit spreads blow out. The high yield index widens from 380 basis points to 850 basis points in 3 trading days. Investment grade spreads move from 110 to 320 basis points. By March 5th, corporate bond markets are essentially frozen. Primary issuance stops completely. Secondary market liquidity vanishes. Bid-ask spreads that should be 5 to 10 basis points are now 100, 200 basis points. Market makers withdraw. Electronic trading platforms malfunction under volume. The Fed responds on March 7th with emergency rate cuts. 50 basis points immediately, signaling more to come. But rate cuts don't solve the fundamental problem. Too much debt, not enough cash flow, maturity walls approaching. Lower rates help at the margin, but can't prevent the cascade of defaults that's now inevitable. By March 15th, 3 more corporate defaults are announced. 2 are retail, 1 industrial. Combined debt, $18 billion credit derivative contracts trigger. Banks holding these bonds face immediate losses. The credit crisis that was theoretical is now very real. April 2026. Global contagion. Begins April, brings the first wave of international transmission. European banks heavily exposed to U.S. credit markets report Q1 losses. Deutsche Bank announces $12 billion in credit-related write-downs. BNP Paribas reports $8 billion, Barclays $6 billion. Share prices collapse 30-40% in days. The dollar funding squeeze hits hard. Cross-currency basis swaps blow out to levels not seen since 2008. European and Asian banks that borrow dollars to fund dollar operations face suddenly prohibitive costs. They begin shrinking dollar balance sheets, reducing global dollar liquidity. Commodity prices start their descent. Oil falls from $83 to $71 per barrel as demand forecasts are slashed. Copper drops 15%, iron ore falls 12%. The decline is orderly at first, a market adjusting to recession expectations. But the seeds of catastrophic collapse are planted. China's economy, already weakening throughout 2025, deteriorates further. Export orders fall sharply as U.S. and European demand contracts. The property sector, in slow motion crisis for 2 years, faces accelerated decline. New construction falls 25% year over year. Property prices in Tier 1 cities drop 8% in 1 month. By April 30th, global equity markets are down approximately 18% from their January peaks. Credit markets remain largely frozen. Central banks have cut rates aggressively. The Fed is now at 3.5%, down from 4.75% in January. The ECB has cut to 2.5%, but rate cuts aren't restoring confidence or liquidity. May-June 2026, the recession confirmation. May brings official recession confirmation. U.S. GDP contracted 2.1% annualized in Q1. Economists expect worse for Q2. Corporate earnings season is disastrous. S&P 500 earnings down 18% year over year, with worse guidance for upcoming quarters. Unemployment begins rising. The U.S. rate moves from 3.8% in February to 4.9% in May to 6.2% in June. Weekly jobless claims surge. Layoff announcements dominate headlines. Tech companies, financial services, retail, manufacturing, all cutting headcount aggressively. European recession is confirmed in late May. GDP contracted 1.8% in Q1. Germany, the engine of European growth, is hit particularly hard, down 2.5% as exports collapse and manufacturing contracts. The Eurozone periphery, Italy, Spain, Portugal, face even steeper declines. June brings the first emerging market currency crises. The Turkish lira collapses from 32 to 48 against the dollar in 3 weeks. Capital controls are imposed but fail to stem outflows. The Argentine peso falls from 350 to 520. Egypt's pound depreciates sharply despite central bank intervention. Commodity prices accelerate their decline. Oil hits $50 per barrel. Copper falls to $3.20 per pound. Iron ore drops to $80 per ton. Commodity exporting economies face severe terms of trade shocks. Brazil, Russia, South Africa, Australia all see currencies depreciate and growth forecasts slashed. July-September 2026, false hope and dashed recovery. July brings a brief period of false hope. Equity markets rally 12% from June lows. Volatility decreases. Commentary shifts to worst is over and buying opportunity. The Fed pauses rate cuts, believing they've done enough. The narrative becomes short, sharp recession, recovery by year end. This proves catastrophically wrong. August reveals the depth of the crisis. Corporate defaults accelerate. 12 major defaults announced in the month, totaling $47 billion in debt. The default rate for high-yield bonds hits 8.5%, the highest since 2009. Banks report Q2 results showing massive credit losses. Several regional banks face failure. The commercial real estate crisis erupts. Office building valuations fall 30% as vacancies surge and refinancing becomes impossible. A major REIT defaults on $6 billion in debt. This triggers forced selling across the sector. Banks with CRE exposure face severe stress. September brings the first major bank failure. A large regional bank with $280 billion in assets, heavily exposed to CRE and corporate credit, becomes insolvent. The FDIC takes control. Depositors above insurance limits face haircuts. This shatters confidence in the banking system. Bank runs begin, not physical runs, digital runs. Customers transfer deposits from regional banks to money market funds or the largest too-big-to-fail institutions. Within 2 weeks, regional banks lose $400 billion in deposits. Several more face failure. The FDIC's insurance fund is strained. October-December 2026, deepening crisis. October forces a policy reckoning. The Fed, which paused rate cuts in July, resumes aggressive easing. They cut 75 basis points in an emergency meeting. They announce unlimited liquidity facilities for banks. They restart asset purchases. QE is back. But monetary policy is pushing on a string. The problem isn't lack of liquidity, it's insolvency. Companies can't service debt at any interest rate when revenues are falling 20 or 30%. Banks can't lend when borrowers are defaulting. Lower rates don't fix balance sheet problems. Fiscal policy remains gridlocked. Congress debates stimulus packages, but partisan divisions prevent action. Proposals range from $800 billion to $2.5 trillion. Democrats want household support and unemployment benefits. Republicans want corporate tax cuts. No compromise emerges. November brings the China hard landing. Q3 GDP growth is announced at 1.2%, the weakest in decades and likely overstated. Property sector collapse is now undeniable. Major developers have defaulted. Construction has essentially stopped in many cities. Local government finances are in crisis. The yuan depreciates sharply despite PBOC intervention. It moves from 7.2 to 8.1 against the dollar. Capital flight accelerates despite strict controls. Foreign reserves fall $300 billion in 3 months. China's crisis is no longer slow motion, it's acute. December ends the year in despair. U.S. unemployment hits 8.8%. GDP contracted 4.2% for the full year 2026. Corporate defaults totaled $340 billion, the highest ever recorded. Equity markets are down 38% from January peaks. Housing prices have fallen 22%. Global conditions are worse. Europe contracted 5.1%. China's real growth likely negative despite official 1.2% figure. Emerging markets in severe crisis. At least 8 currencies have collapsed more than 40%. 5 governments face default. 3 have imposed capital controls. The year ends with no recovery in sight. Every economic indicator points down. Credit markets remain frozen. Banks are failing. Unemployment is rising, and the policy toolkit appears exhausted. Year 2, March 2027, February 2028. The failed recovery Q1 2027. Stabilization attempts. Early 2027 brings coordinated policy efforts. The G20 meets an emergency session. Leaders pledge cooperation. Central banks coordinate rate cuts. The Fed goes to 1.5%, the ECB to 1.0%. The Bank of Japan expands negative rates further. The fiscal package finally passes Congress in February. $1.8 trillion over 2 years. Unemployment benefits extended, infrastructure spending. Tax credits for businesses that retain workers. The package is smaller than economists recommended, but larger than nothing. Markets rally on the news. Equities gain 18% in 6 weeks. Credit spreads narrow modestly. Commentary shifts to policy response adequate and recovery starting Q2. Economic forecasts are upgraded from catastrophic to merely very bad. This optimism is premature. Q2 2027. Reality reasserts. April brings disappointing data. Unemployment isn't falling. It's rising, now at 9.4%. GDP contracted another 1.8% in Q1 despite stimulus. Corporate defaults continue at crisis levels. The fiscal stimulus is having minimal impact on real economy. Why isn't stimulus working? Multiple reasons. Much of it goes to debt service, not new spending. Companies receiving support use it to avoid bankruptcy, not to hire. Consumers, traumatized by job losses and asset declines, save rather than spend. The multiplier effect is minimal. May reveals the European sovereign debt crisis 2.0. Italy's debt-to-GDP ratio hits 156%. Bond yields spike to 7.2% as investors question sustainability. Spain's yields rise in sympathy to 5.8%. Portugal faces similar pressure. The ECB faces an impossible choice: support sovereign bond markets through purchases, violating their mandate and German opposition, or allow yields to rise, risking sovereign defaults. They choose muddled middle ground, limited purchases with strict conditions. This satisfies no one and fails to calm markets. June brings the first sovereign default of the crisis. A mid-sized emerging market country with $45 billion in external debt announces it cannot service obligations. Negotiations with creditors break down. Default is declared. This triggers contagion fears across emerging markets. Q3 2027. Contagion spreads. July sees 3 more sovereign defaults. Combined external debt, $130 billion. The IMF lacks resources to support all countries simultaneously. Donor nations facing their own crises resist expanding IMF funding. Each default makes the next more likely as investors reassess all emerging market exposure. Currency collapses intensify. By August, 15 emerging market currencies have fallen more than 50% against the dollar since the crisis began. Import-dependent countries face severe inflation. Food and energy prices skyrocket. Social unrest spreads across multiple countries. August brings the first major advanced economy bank nationalization. A European megabank holding $1.6 trillion in assets faces insolvency from peripheral sovereign debt exposure and credit losses. The government takes control, wiping out shareholders and imposing losses on bondholders. This triggers financial contagion across Europe. Other banks with similar exposures face runs. Deposit flight intensifies. The European banking system fragments. Money flows from periphery to core, from weak banks to strong banks, creating liquidity crises everywhere. September forces ECB intervention at unprecedented scale. They announce unlimited sovereign bond purchases for Italy and Spain, breaking their previous limits. They provide $800 billion in emergency liquidity to banks. The euro falls sharply on this news, from 1.06 to 0.94 against the dollar. Q4 2027, entering depression territory. October brings grim milestone. U.S. unemployment hits 11.2%. This exceeds the peak of the 2008-2009 crisis. Underemployment, including part-time workers seeking full-time work, exceeds 18%. Real household income has fallen 15% since early 2026. Housing crisis deepens. Prices are now down 35% from peaks. Foreclosure rates surge. Underwater mortgages exceed 30% of all mortgages. Banks hold massive inventories of foreclosed properties they can't sell. New construction has essentially stopped. November confirms global depression. World trade volume is down 19% from pre-crisis levels. Industrial production globally has fallen 12%. Every major economy is in recession. No growth engines remain, not the US, not China, not Europe. China's situation is critical. Officially reported Q3 growth is 0.8%, the first official contraction in decades. Real growth is likely much worse. The property sector has collapsed. New starts down 65% from peak. Youth unemployment exceeds 25%. Social stability concerns mount. December 2027 ends year 2 with the realization that recovery isn't coming. This isn't a normal recession with V-shaped recovery. This is L-shaped stagnation at best, continued decline at worst. GDP for 2027 contracted another 2.3% in the US, 3.1% in Europe, 2.8% globally. Year 3, March 2028, February 2029. Political upheaval, Q1, 2028. Policy exhaustion. Early 2028 reveals complete policy exhaustion. The Fed's rate is at 0.25%, effectively zero. They've expanded their balance sheet to $11 trillion through asset purchases. They're buying corporate bonds, municipal bonds, even ETFs. Nothing is moving the needle on growth. Fiscal policy is constrained by debt levels. The U.S. debt-to-GDP ratio has reached 138%. Deficit spending continues, but political will for more stimulus has evaporated. Republican gains in 2026 midterms have shifted Congress toward austerity concerns. February brings the first major political casualty. A European government falls after mass protests over austerity measures demanded by EU creditors. Unemployment in this country exceeds 16%. A populist coalition takes power, promising to reject EU demands and restore sovereignty. March sees similar political shifts across Europe. Italy elects an anti-EU government. Spain's ruling party loses to coalition of left and right-wing populists. Greece, still scarred from 2010's crisis, elects radical left government promising debt repudiation. Q2, 2028 social instability. April through June brings wave of social unrest globally. Protests, strikes, riots. In emerging markets facing currency collapse and inflation, unrest becomes violent. Governments respond with crackdowns, creating cycles of violence and repression. 3 emerging market governments face coups or revolutions. Political instability destroys remaining investor confidence. Capital flight intensifies. These countries spiral from economic crisis to state failure. Advanced economies aren't immune. Major protests occur in Paris, Madrid, Athens, London. Occupy-style movements reemerge. Anger targets banks, governments, wealthy elites. Trust in institutions reaches all-time lows. May brings the first serious discussion of EU fragmentation. Italy's new government threatens euro exit if debt relief isn't provided. The Ital-exit debate dominates European politics. Bond markets panic. Italian yields spike to 9.5%, Spanish to 7.2%. Germany faces impossible choice: provide massive fiscal transfers to support southern Europe, politically unacceptable domestically, or allow euro fragmentation, destroying decades of integration. They choose delayed middle ground that satisfies no one. Q3 2028 system fragmentation. July sees the first major currency union exit threat become credible. Italy begins technical preparations for euro exit, though officially denying it. Capital flight from Italy accelerates. Banks face massive deposit withdrawals. ECB emergency lending to Italian banks exceeds $300 billion. August brings defaults on dollar-denominated debt at unprecedented scale. Corporate defaults in 2028 YTD reach $420 billion globally. Multiple governments in default. Credit markets that showed modest recovery in early 2028 freeze again. September reveals the scope of pension fund crisis. Underfunding in U.S. corporate and state pension plans reaches $2.8 trillion. Expected returns of 7% haven't materialized. Actual returns have been deeply negative. Benefits must be cut or funding massively increased. Neither option is politically viable. Q4 2028, institutional breakdown. October brings coordinated but ineffective policy response. G20 announces new framework for global economic stability, pledges to increase IMF resources, coordinate fiscal stimulus, prevent competitive devaluation. The announcement is long on rhetoric, short on concrete commitments. Markets briefly rally, then resume decline when no actual policy implementation follows. Trust in international institutions is broken. Each country increasingly pursues national self-interest over global coordination. November sees 3 more major bank failures across different countries. Depositor losses occur despite insurance schemes. The schemes are overwhelmed. Bank runs become reality, not just possibility. Some countries impose temporary bank holidays to prevent collapse. December 2028 marks 3 full years of crisis. Cumulative global GDP decline, 11.7%. Cumulative wealth destruction, estimated $55 trillion. Unemployment in advanced economies averages 10.8%. In emerging markets, 17.3%. Over 180 million people have fallen into poverty globally since the crisis began. Year 4, March 2029, February 2030, the long stagnation. Q1 2029, zombie economy. Early 2029 reveals a new reality. The crisis isn't getting worse, but it's not getting better either. The economy has stabilized at depression levels. Growth has stopped declining but hasn't resumed. This is the zombie economy, alive but not living. Corporate sector is hollowed out. 1/3 of companies are zombie companies, unable to cover interest payments from operating income, surviving only through debt rollovers and central bank support. Creative destruction has been suspended. Bad companies don't die. Good companies can't invest and grow. Banking sector is broken. Banks with massive non-performing loans can't lend normally. Regulators have allowed forbearance, not recognizing loan losses immediately, which maintains paper solvency while destroying actual lending capacity. The financial system is frozen. February confirms what many suspected. Japan-style stagnation has arrived in the West. Zero interest rates, massive central bank balance sheets, deflation pressures, aging demographics, debt overhang, the same factors that created Japan's lost decades now global Q2 2029. Generational scarring. April studies reveal the depth of generational impact. Millennials have lost 15 years of wealth accumulation. Gen Z faces 23% youth unemployment with grim prospects. Delayed household formation, marriage, children, all demographic indicators declining. May brings the college enrollment crisis. Applications are down 28% from pre-crisis levels. Why invest in expensive education when job prospects are terrible? Student loans seem unpayable. Many young people choose work over education, but even low-skill jobs are scarce. June reveals the small business apocalypse. 42% of small businesses that existed in early 2026 have permanently closed. New business formation is at multi-decade lows. The entrepreneurial engine of the economy has stalled. Got Q3 2029. Permanent structural change. July analysis confirms permanent structural changes to economy. Remote work, accelerated during crisis, is now permanent. Office space demand down 40%. Retail apocalypse is complete. E-commerce now 65% of retail versus 35% pre-crisis. Thousands of malls and shopping centers abandoned. August shows labor market transformation. Gig economy has exploded. 30% of workers now independent contractors rather than employees. Benefits, stability, career progression, all gone for a large portion of workforce. Insecurity is the new normal. September reveals the extent of deglobalization. Global trade as percentage of GDP has fallen to levels not seen since the 1990s. Supply chains have been reshored or nearshored. Just in time, replaced with just in case. Efficiency sacrificed for resilience. Q4 2029. Political realignment. October sees major political realignment. Traditional center-left and center-right parties have collapsed across multiple countries. Populist, nationalist, and anti-establishment movements dominate. The political consensus that supported globalization and free markets for decades is shattered. November elections in multiple countries bring radical parties to power. Platforms include debt repudiation, capital controls, nationalization of key industries, withdrawal from international agreements. The post-war liberal international order is disintegrating. December 2029 marks 4 years. The economic data shows stagnation. GDP is slightly above crisis lows, but far below pre-crisis levels. The US economy is 8.5% smaller than early 2026. Europe is 11% smaller. China claims 5% smaller, but reality likely 12-15% smaller. Year 5, March 2030, February 2031, the new abnormal Q1 2030. Acceptance. Early 2030 brings psychological shift. Acceptance. The recovery everyone expected isn't coming. This is the new reality. Adapt or suffer. Expectations recalibrate to permanent lower living standards, higher unemployment, greater insecurity. Consumer behavior has fundamentally changed. Savings rates remain elevated at 12-15% despite low interest rates. Spending on experiences down, spending on durables down. People hoard cash and essentials. Trust in financial assets destroyed. February sees the first major central bank admit defeat. After 5 years of zero rates and $14 trillion balance sheet, the Fed announces it has done all it can. Monetary policy cannot solve structural problems. Fiscal and structural reforms needed but politically impossible. Q2, 2030. Fragmented World April reveals the extent of geoeconomic fragmentation. The world is split into competing blocks. US-aligned bloc, China-aligned bloc, non-aligned countries. Trade within blocks functions reasonably. Trade between blocks is restricted. Global economy has balkanized. May shows the collapse of multilateral institutions. The WTO is effectively defunct, rulings ignored, new members blocked, dispute resolution broken. The World Bank and IMF are marginalized. Borrowers reject conditionality, donors withhold funding. Global governance has failed. June brings the formal announcement of parallel payment systems. China's CIPS system now processing more international transactions than SWIFT for certain corridors. Digital yuan being adopted by Belt and Road countries. The dollar's monopoly on international payments is ending. Q3, 2030, social contract breakdown. July, data shows the social contract breakdown. Income inequality has reached levels not seen since the 1920s. The top 1% have recovered wealth through asset price inflation from central bank policies. The bottom 50% are worse off than before the crisis. Social mobility has collapsed. Children born into bottom quintile have less than 5% chance of reaching top quintile in their lifetime. Education no longer guarantees advancement. The American dream, already fading, is now dead for most. August sees the beginning of serious discussion about universal basic income. With traditional jobs scarce and likely to remain so, guaranteed minimum income becomes politically viable. Several countries announce pilot programs, Q4 2030, Q1 2031. 5 years later, September 2030 through February 2031 brings reflection on 5 years of crisis. The statistics tell the story. Global GDP is 9.2% below early 2026 levels. 50 million jobs lost permanently. Over 60 trillion in wealth destroyed. Government debt has exploded. Advanced economies average 145% debt to GDP. Pension systems are insolvent. Healthcare systems are strained. But statistics don't capture the full impact. Trust in institutions destroyed. Faith in markets shattered. Belief in progress abandoned. An entire generation scarred by trauma, political radicalization, social fragmentation, international cooperation replaced by competition. The world that emerges from 5 years of crisis is fundamentally different from the one that entered it. The assumptions that governed economic policy, free markets, globalization, central bank omnipotence, perpetual growth, all proven false or inadequate. February 2031 marks exactly 5 years since the crisis began. There are tentative signs of stabilization. GDP growth has returned, albeit weak, projected 1.2% for 2031. Unemployment is peaked and is slowly declining. Financial markets function, though with much less liquidity and trust than before. But this isn't recovery to the old normal. This is adaptation to a new abnormal. Lower growth, higher unemployment, greater government intervention, less globalization, more restrictions, reduced living standards for most, greater inequality, less opportunity. The crash that began in March 2026 created ripples that will echo for decades. Some countries handle the crisis better than others. Some adapt more quickly, some find new paths to prosperity. But no one returns to the world of early 2026. That world is gone. What exists 5 years later is something different. Perhaps in time it will be something better, more sustainable, more equitable, more resilient. But in February 2031, 5 years after the crash began, what exists is still worse. The first 5 years after the 2026 crash, a timeline of collapse, failed recovery, political upheaval, and permanent transformation. The numbers tell part of the story, but the human cost, the dreams deferred, the lives disrupted, the futures destroyed, that can't be measured in GDP or unemployment rates. This was not inevitable. Choices made before the crisis, excessive debt, inadequate regulation, inequality, short-term thinking, created the vulnerabilities. Choices made during the crisis, delayed response, political gridlock, inadequate coordination, made it worse. The timeline of the first 5 years shows how quickly systems can collapse, how hard recovery can be, how lasting the damage can become. It's a warning about fragility, about the importance of resilience, about the costs of ignoring systemic risks until too late. 5 years after the crash, the world continues. People adapt, economies function. Life goes on, but it goes on in a world diminished from what came before and far from what could have been.